Kazakhstan, the world's 9th largest country by land area, is rich in mineral resources that have long supported its economy. However, resource depletion and the need for new investments challenge the sustainability of its mining sector. With over 30 years of limited greenfield exploration, Kazakhstan is revitalizing its mining approach through policy reforms, technological advancements, and strategic investments. Recent government initiatives focus on updating subsurface regulations, offering tax incentives, and encouraging private sector participation, leading to increased private investment in exploration. The country aims to attract both domestic and international capital by tapping into its underdeveloped mineral wealth, including rare earth metals. Artificial intelligence is enhancing data processing, while remote sensing technologies like hyperspectral imaging and LiDAR improve geological mapping. The government and companies are also employing advanced exploration techniques to access previously unreachable geological formations. Despite progress, challenges remain, such as the need for sustainable resource management. Kazakhstan's strategy integrates environmental considerations with economic growth, exemplified by projects like the Aras Minerals, Saritogan Graphite Mine, and First Quantum Minerals sediment-hosted copper exploration. Meanwhile, companies such as Scythian Mining Group and East Star Resources highlight the role of IPOs and international partnerships in scaling exploration efforts. This session, with the keynote from S&P Global, will explore current trends in mineral exploration, costs and emissions, offering perspectives from industry leaders on navigating technology, policy and investment in Kazakhstan's mining future.
Good afternoon, everyone. Today we have, I think, quite an interesting topic, much needed topic, and a very diverse subject matter experts that we're going to be discussing investing in mining and exploration in Kazakhstan. The way I moderate, this is all about the time allocated is about you, and it's about you. So I'm going to be very short with the introductions. When time comes with panel, I have some questions just to get the discussions going. Feel free to change the questions as you see fit. Just very few introductory. Investing, I kind of simplify it. We're going to be looking at these things: pathway to capital, securing capital, and delivering capital. I think we all understand, for those of you like us that have been in the finance business, there's very differences in debt-like instruments versus equity-like instruments. There are quite a bit of differences between public finance and private finance, so we're going to be touching on those. We, in the mining industry, we welcome the government's involvement. This is a paradigm shift as we see it. The EU Central Asia Summit that just happened in Samarkand, I think, is a testament to that. But what does that all mean to those three things? Pathway to capital, securing capital, delivering capital. So today, you will have three presentations and a panel. We'll introduce the presenters one by one now, so to give you more time. So on the alternative financing, which is an important component of the financing, is Temirlan Mukhanbetshanov. He's a board member with Astana International Finance Center. Raising capital in the capital markets. So we have the perfect representation from London Stock Exchange, Ayuna Necheva. My good friend Agop will be talking about what EBRD provides on the financing side as well. When the time comes to the panel discussions, we have three additional panelists. One is, again, a good friend of mine, Cassie Beysembetov. He is the managing partner of Alphamar Fund. Stefan Schultz, which owns his own company, does financial advisory services. And Alken Koambay, he is the CEO of BAST. So with that, I will give the floor to Temirlan.
Thanks. Thanks a lot and good afternoon to everyone. As you can see, I'm going to speak about alternative financing for mining companies. Before I dwell on this topic, I probably would like to give some context about the public markets for mining companies, public debt and public equity markets. I pulled up the recent IPOs of mining companies done in the last 5 years. As you can see from the graph, basically both the number and the size of IPOs is coming down, is in a downward trend. Obviously, this is coming off from a strong spot year in 2021, but still, compared to other industries, mining stocks have been sort of out of favor of global international investors, I would say. The split in terms of size have been more or less consistent, I guess, across the years. So if you look up those IPOs in the breakdown of local versus cross-border, I mean, you can see that the figures haven't changed much. So, mining as an industry is still a largely local business, and due to its very nature, because it's very tied to local regulations and local risk factors. And obviously, to be able to raise money through an IPO, you need a strong local investor base, and hence the success of Canadian stock exchange, Australian stock exchange, India, and China. When you look up those two graphs, it's not surprising that IPO activity have come down. And these are the valuations for metals and mining sub-index of ASX, which is Australian Stock Exchange, and TS6V, Toronto Stock Exchange. So these are the one of the mostly primary listing venues for mining stocks in particular. And so share price have not collapsed, obviously, but they've come down and remained flat for most of that period. And if you look up the annualized 3-year return for AS6 and TS6V, it's -8% and -15% respectively. So I guess the major takeaway from these two slides is that markets haven't been really supportive of mining stocks lately, and this is also confirmed by public debt issuances, which again is trending downwards in the last 5 years. Obviously, this is largely due to increased interest rates, but still, I guess there is some factor of investment sentiment, and obviously the traditional debt markets are pretty much shut for junior miners or companies doing the early stage exploration. I think one of the reasons, and one of the alleged reasons for decreasing in debt issuances is the growing importance of alternative financing. That's what I'm going to speak about in a minute. So alternative financing is slowly displacing some gap left by traditional public and public markets. So alternative financing is quite a broad topic, which includes many forms of financing, mezzanine financing, different convertible structures, asset-backed lending, etc., etc. But I'm gonna focus on two major instruments today. It's streaming and it's royalty. Those structures are quite new for our region, and I'm not aware of any transactions in streaming and royalty that took place in our region. So basically, what is streaming and what is royalty? In essence, it's a financing arrangement whereby a streaming and royalty company provides upfront investment in exchange for predetermined or pre-agreed share of future revenue in case of royalty, or future production in case of streaming. Basically, it's an instrument that provides possibility to basically avoid equity dilution and increase the debt burden. Essentially, basically, one can view those instruments as a contingent future liability of the company. So while they are while they are very similar conceptually, there are a few important differences. So I'll probably not go one by one, but highlight the major ones. So I guess from legal standpoint, the major differences in legal standpoint, basically streaming is a contractual relation between two private parties, while the royalty is basically an interest in real property, i.e. the land, right? So when the title of the mine changes, the royalty stays with the land basically, and that's, I guess, informs the whole structure, the structure of streaming and royalty. So the royalty is usually provided at the earliest stage of exploration and comes in smaller size, while the streaming comes at a more later stage when there is more visibility in terms of production, and obviously this comes in the larger tickets. Royalty is applied over lifetime. So if a mine runs for 25 years, then they 3% royalty, for instance, would be applied over entire lifetime. While streaming is usually capped until certain volume of production is reached. Just to give a better sort of sense of how the structures, let's take some real life examples. So this is streaming. Streaming deal that was put together, a syndicated streaming deal that was put together by Franco-Nevada, which is the largest streaming player in the world, and Cisco. So that's a 700 mil facility, which comes in two bulks. Which is split between pre-construction and construction phases. And so the key terms is that basically in exchange for this upfront financing, the mining company, which in this case is if I'm not mistaken, a company operating in Peru, in South America. So they basically will sell 40% of their gold production until around 500,000 ton of gold is produced at 20% of spot gold price. That's how it works, basically quite straightforward, I guess. And there are obviously a lot of conditions attached to them, and the most important one is the change of control. So what happens when the change of control takes place? Basically, the finance providers can terminate the deal and request the advance to be repaid with some certain interest on top of that, of course, and the seller of the royalty can buy back certain portion of the stream. This is a case of a royalty provided by Royal Gold, which is another large player in the market. There was a 51 million cash transaction in Canada, if I'm not mistaken, to Barrick Gold. So it consists of basically two royalties. One is based on NSR, which is net smelter return, and the other is based on gross smelter return. So it is a bit less, let's say, complicated, but so the structure means that the company will receive 0.7% of NSR over the life of the mine. And the GSR will cease at when the mine reaches 780,000 ounces. So what are the sort of major trends, and who are the major players in this space? The exact number is difficult to estimate because all those deals are quite private in their nature. But the estimate is around 2 to 3 billion a year. But I guess the number is larger, still from 60 to 70% of the capital is financed by big players you see on the right hand side, and they mostly finance byproducts. So they don't usually go and finance core products. They usually finance byproducts, i.e. a copper deposit producing some gold might be a good target for such transaction. the whole concept was born in Canada, both the streaming and the royalty, and like slowly it started expanding into United States, South America, and I'll show later on the slides that this instrument is growing geographically into Africa, Australia, some parts of Europe. And lastly, there is clear trend for like bundle deals when both the royalty and stream is put together in one package, and usually on top of that there is some subordinate or like mezzanine financing. So what are the major benefits for mining companies? I guess like I won't go by everyone, but like the two most important is obviously dilution of existing shareholders. That's what most shareholders of mining companies want to avoid, and this is a perfect instrument to do that. And better cash flow management, because like the payment is basically very much linked to production compared to traditional debt, whereby like your interest schedule might not match the realities of your production. And obviously there are some options that can be embedded into the agreements, like repurchase options. So this is like a good opportunity, I guess, when the upside, when there's too much upside to lose. And obviously among the drawbacks, there are always drawbacks, is the upside that you can give up when the prices of when the spot prices are much higher. So just want to quickly go through the geography assets. That's the point that I touched on earlier. So like as you can see, it's still like mostly Canada and North America. This is Franco-Nevada, but they have like assets in South Africa. They have few assets in in West Africa and in South Africa and Australia. This is Wheaton Precious. They're mostly focused on, again, like North and South America, and have few assets like in Europe. I guess like it's like Sweden, right? Like Spain, Portugal. This is Royal Gold. Again, like pretty much the same picture. South and North America, Australia, some parts of Africa. And this is Triple Flag, like recent, fairly new market player. And I guess like what is interesting in this map is that which is close to Kazakhstan, which is Mongolia. It's like eastern part of Mongolia. So the deal was put together in 2017, and there was additional follow-on investment in 2019. So I guess the three key takeaway points from my presentation is that there is alternative financing, which is slowly evolving and like taking a larger share of financing. It'll never be able to replace conventional debt and equity, obviously, but still it is an alternative. It's not better, it's not worse, it is alternative to conventional finance. Secondly, as you see, the geography of assets is enlarging, and I'm sure Kazakhstan I guess we'll see transactions in Kazakhstan as well, because when you think about the reasons when those big companies expand in a new geography, they always assess how investable a jurisdiction is. So from different angles, from political risk point, and I don't see Kazakhstan being any less investable than Mongolia, for instance, or some parts of Africa. So I have no reason to doubt that this streaming and royalty financing would also would start playing some role in Kazakhstan. And last point, I guess, is about jurisdictional risk. So I'm a board member of Astana International Financial Center. So I can now mention that we're actually lucky to have such jurisdiction in our country, because it really drives down the risk premium for the country, and it's exactly what companies like Wheaton, like Royal Gold or Franco-Nevada look for when they assess a jurisdiction or a country. So having a jurisdiction which operates under English common law framework, has independent court system, is definitely a positive factor in their decision making, I guess. So yeah, I'll stop here. Thank you.
Thank you, Timirlan. For those of you that are seeking capital, I really would encourage you to look at the streaming component. You have given a wonderful summary of it, but it could come in many different forms. So I would really encourage you to look at that. The next one is raising capital in the capital markets, focused on London Stock Exchange. Alina?
У нас на лондонской фондовой бирже платформа такая управляется кнопочками. Так как я маленького роста, ее можно сделать ниже. Но здесь мне порекомендовали использовать стул. Я надеюсь, в видеозаписи вы вырежете этот момент неэлегантно.
But I hope that in video recording you will eliminate it. Hello everybody, my name is Ayuna Nechaeva. I am the head in Europe of London Stock Exchange. I have been working for more than 15 years in LSE, and I have been dealing with the issue of capital investment through Euro bonds and funds. I will tell you about London Stock Exchange because over the last 5 years the situation there has been changed, and I will also continue the topic that Timirlan has started. I will talk about the mining sector, and I'll speak a bit about the requirements that investors have to companies that wants to attract capital either through IPO or through bonds. Nowadays, the London Stock Exchange is the world-leading financial market infrastructure. The capitalization is more than 80 billion. We operate in more than 190 countries, and one of the main businesses is not only to the capital markets, but also data analytics is our part. So we speak about financial data, about analytics. One of our competitor at the global arena is Bloomberg. As you see from this slide, there are 3 parts: capital formation, data analytics, and capital optimization and risk management. And this also includes indices, which is the indices that is famous all over the world. Speaking about numbers, London Stock Exchange, the part that we think about when we speak London Stock Exchange, and this is the part where I work, this part of business is the largest in Europe, number 1 in Europe. The market capitalization is almost 6 trillion, those issues listed on LSE markets, more than 25,000 listed debt instrument, and more than 340 listed funds, investment companies. But of course, there are even more investors. Let me briefly tell you about the situation happening in the at the capital markets. You know, the year 2021 was a fantastic for global markets. In London Stock Exchange, we saw the record amount of capital, almost 70 billion pounds, and it was one of the best years after financial crisis. We all were very happy, but in 2022, as you know, due to geopolitical events, the markets went down, not only in Europe, but all over the world. And then some other pressures appeared, for example, increasing of rates, inflation, problems with supply chain due to the situation in China, and so on and so forth. And everything impacted the markets. Year 2023 was the lowest one, if we speak about the attracted capital. But last year, everything started to be rebound. Right now, we are in a cycle that goes upward, or in a line that goes upward. If we look at the market history now, I think we are gaining our trends. But of course, the Trump's policy impacted. We know that markets went down since the beginning of the year. Yesterday, they, let's say, revived for a couple of points, but let's see what happens further. Of course, investors now have understanding that the risk shall be evaluated and assessed the specific way. We see that investors put money in a more reliable things, for example, in gold. So we'll see what happens next. Over the 2024-2025, more than 41 billion was raised in London, and it was the biggest amount than in any other stock exchange, and 3 times more than in the Paris. We are number 4 in global Europe, but our main competitor is, of course, American stock exchanges. The most important for companies, and why actually people ask question, why companies go to IPO? What's the essence? What's the main idea besides capital raising? Well, you need to understand that all these efforts that you as company do, I mean, you want to increase your corporate structure, financial reporting, and so on and so forth, you receive not only the capital raised in the beginning of the transaction, but also you receive the access to the constant liquidity when you're at the market. Example, one of the most active years where the additional capital was raised by companies listed on IPO, listed on stocks. I mean, if you look at these largest deals, for example, Halion, 11, almost 12 billion were attracted through the banks. A big amount of money companies that didn't start their production yet, but they attract the capital so that to continue their operation and so that to come to full production cycle. It's a very important moment which simplifies the work for you. When you are listed, you have the access to additional capital. As for Kazakhstan, let me mention Air Astana that listed last year with our exchange. Then, as for other key companies, I mean from our sector, this is Kazatomprom. Kazatomprom trades really well, and the main shareholder, Samruk Kazana, attracted additional capital. Let me skip this slide and I'll show you the other one. For us, it is very important with the companies from all over the world. Well, actually, UK is a small country, but the London Stock Exchange, London Financial Centre, is a global center, and more than 35% of all companies in our platforms are non-British. They are outside, not only outside Great Britain, but also all their profit comes from external markets. I am the head of Europe and CIS department, and here you can see my portfolio, 157 companies, more than $768 billion. It's a total capitalization. You see 35 CIS companies listed in London, and you see the names: Air Astana, Halyk Bank, Kazatomprom. They're from Kazakhstan. Speaking about some new things, if you visited my presentation last year, let me tell you what progress we have. It is very important, after Brexit, it was important for us to increase the competitiveness of London platform in comparison with American platforms. As a London exchange, jointly with the UK government and regulator, we have conducted a number of reforms. These reforms covered all aspects of funds raising, not only the rules on listings, like previously we had the standard premium listing, now we have just one listing at our main platform. We have simplified some requirements with regard to corporate governance, but it was not just to simplify. We made it so that to harmonize, so that the right of investors were still protected, but so that there would not be unnecessary requirements for companies. Also, some other issues on research, on analytical reporting were included, on retail, attracting of retail investors. All these aspects are being discussed now. Almost 80% of all reforms have been conducted. For example, we reduced the requirement on free float, so the percent of the capital that you give to investor from 25% to 10%. And just recently we've announced that European companies that trade in euros, they could also be in FTSE 100, FTSE 250. And now companies that trade in US dollars, in euros, they also can be here. And let me speak. So first I want to give you the overview of our platform, but as for mining sector, let me tell you the following. 169 companies are traded, and 3 out of 10 largest companies there in London Stock Exchange. You see that London takes 15% of all global market in public companies, and you need to understand that the most part of these companies are small companies. Quite often people say that if it's a London Stock Exchange, then you have to be a company with a big size. But if you look, some of the companies in the size up to 5 millions. Then the second from 10 to 50. This is a market cap indicator. It is very important because quite often we see junior companies or companies that want to grow or companies that want to attract funds so that to grow while being on the platform. As for investors, the previous speaker has already mentioned about investments, and it is very important to have access to public investors. Why? Because these are passive investors. They do not interfere the activity of the company. So they invest at the IPO or at the attraction stage, but they do not play actively there. And this way of capital raising differs from strategic investments or from private equity, because such investors, they would be in the BOD, they would participate in defining the strategy of the business and so on. So which deals we have had in recent time? Well, we talked a bit about tendencies in the deals, and I want to say that the deals are there. Look at the London market. We had 5 IPO from mining sector. I would like to mention European Green Transition company that deals with, that works with the exploration of rare earth metals and copper in Sweden. It's a small company, but they raised 8 million and their cap was 18. And of course, the demand is for companies that deal with critical minerals, for company in rare earth metals, and this issue also raised at the previous panel session when people were speaking about sustainability. I have 2 more minutes and I would like to tell you about the key requirements. I didn't prepare the slide because it's boring to look at the table. So the key requirements to companies that want to attract capital at the public platforms. Well, first of all, the proof of your resources. So you need to have the competent process report. Then financial reporting, 3 years according to IFRS or less if the company works less than 3 years. Of course, the plan, the strategy, what you are going to do, and it's not necessary to have the production stage. You can come at the level of the exploration if you are interested, if you have a very interesting strategic history. And then, of course, the issues related to corporate governance. You need to show that companies puts all the effort so that to comply with the international investors' requirements. So we need to have independent directors, we need to have specialists with global experience. That would be the part of executive committee or non-executive committee. And finally, about debt markets. One of the most interesting stories of Central Asia is placement of euro bonds. Novaid company, it's a company from Uzbekistan. Evgeny Antonov should have been here, but he was not able to come. They attracted $1 billion by two tranches at London Stock Exchange, and according to estimation, they had the evaluation which is close to sovereign benchmark. It was an excellent example of Central Asian companies that is in the key mining sector, and such company comes to international platform and attracts lots of funds from high quality investors. So with this I stop my speech and I want to thank you.
Thank you very much. Again, a very complicated and we can probably have a different conference associated with raising capital in the capital markets. One thing that I would say is that the part that is boring is actually the part that you really need to pay attention to. We get retained quite often by companies for IPO, and I tell them two things. One is the valuation of what you think the asset is going to be quite different than the valuation determined by the capital markets, and be ready to change the way you operate your company because the governance requirements is going to be quite different. So we heard about alternative financing. We heard about a source that you can go to raise capital in the capital markets. Now, in addition to that, EBRD is extremely active in Central Asia, particularly in Kazakhstan, and I think Uzbekistan is a second, close second. So both on the debt and equity side, EBRD is very active in AGOP.
Уважаемые коллеги, добрый день.
Dear colleagues, good day. First of all, I would like to thank organizers of this forum for giving me the opportunity to be here and to present European Bank of Reconstruction and Development. My presentation is quite short, and initially I will tell you a bit about bank, and then I will move to the main topic of my presentation, new opportunities for junior companies, how to attract funds from EBRD. EBRD, European Bank for Reconstruction and Development, is an international financial institute that was launched in 1991, mainly by EU countries to support post-Soviet countries to do the transition in the economy, and since that time the bank has been actively developed, and right now the shareholders of the bank are more than 70 countries. By the way, Kazakhstan is one of the shareholders of our bank, however with a little share. We invest into projects and into companies of almost all spheres of the economy, and taking into account the fact that mining sector is a key sector for many countries, I can say that we are actively supporting this sector in all the countries. Here you can see the map that shows our activities. So you see the Central Europe, Turkey, Central Asia, Mongolia, Middle East, and some countries of the Northern Africa, about 40. But starting this year, the geography of our bank is expanding, and the number of countries and operations increased. We have 6 more countries: Senegal, Cote d'Ivoire, Ghana, Benin, Nigeria, Kenya, and now we are starting to finance into projects and companies from these countries. This slide presents the numbers what business we do in different countries and the numbers. So here on the right you can see that Kazakhstan is one of the key countries of our operations. Last year we provided finances for projects and companies for 913 million euros. This is a record if we look at the history. And as I have already mentioned, we have quite a long list of companies from different industries. We work with natural resources, agribusiness, telecommunication, financial sector, energy, transport, and municipal infrastructure. Well, the main topic and the main slide of my presentation is this one, and this is new opportunities for junior companies to have funds for their activities at the early stages. As a rule, until last year, EBRD funded projects started from pre-feasibility stage. So as a bank, and we are a bank, we are not a strategic investor, and in mining sector, we do not understand everything, especially some technical parts. So that's why we always focused on a more late stage of project development, and this means less risky stages.
Taking into consideration how do we see last 30 years and many countries, all of the operations that we had in many countries, the geological explorations were lagging behind. So that is why we decided to finance projects on the early stages. So pre-feasibility studies. And by the board of directors of the bank, we had adopted EBRD Junior Mining Program, where 100 million euro is invested. So total investment amount by EBRD is expected to be up to 150 million euro. Its initial investment period till the end of the 2029. It is dedicated for the pre-feasibility, feasibility studies to be prepared, and then exit to the study stage where big players and commercial banks are interested in providing the financing for the construction itself. And this is new product for the bank. We had similar deals that we had conducted as exception, but starting last year, we started actively looking at similar projects. And in September, this project had been approved by the Council of Board of Directors, and we had started looking at different projects. On this slide, there are details, requirements. First of all, what we need is to have the estimates of the resources of the project, mineral resources estimate. It is really important because for the stages before, when there are no other studies, it's too risky. So that is why all the estimates of the resources and scoping study could be done by companies' effort. You don't need to have external consultants. So here, the last line, geography, Kazakhstan is not there, but it's the part of Kazakhstan where Kazakhstan is not part of, but this program partially works in Kazakhstan, don't worry. I will repeat myself. Financing by means of share equity, which will prepare the Term of reference, TOR and pre-TOR. So that's all. Yes. Thank you. I would like to wish you best of luck and good business.
You have an office in Kazakhstan, right? And you have an office in Uzbekistan as well? Yeah, okay. How much time do we have for the panel discussion? Is it half an hour or 40 minutes? Okay. So what I'd like to do is, if we can have the panelists just, a few sentences to describe who you represent, a little bit about background, and then I'll start with some questions. This is working? Oh. Okay. Okay. Just pass it.
Well, thank you, Han. Maybe as a brief introduction, Scholz von Gleich is an independent investment bank. We are active in this region for almost more than 18 years. As a team, we have a track record in excess of $70 billion, mainly advising on M&A transactions, buying, selling assets, companies, and capital market transactions, including IPOs, secondary offerings, but both equity and debt transactions. We are active, obviously, here in Kazakhstan. Our main office is in Almaty, but for the entire period of time, we've been active across Central Asia. So we've been doing transactions in Uzbekistan, in Kyrgyzstan, in many countries around, including Mongolia. In the last couple of years, also covering Southeast Asia, doing transactions in Australia and some other places, Europe. Being based here, obviously, a large focus of us is metals and mining, oil and gas, but less and less, for obvious reasons, and financial services. So from a product portfolio, from services, what we can do is we can help clients to understand how best to raise funding at the best terms. We've heard different parties, banks, stock exchanges, alternative financing. Most of these financing, obviously, particularly when it comes down to metals and mining, is focused on later stage. When you know what you have, how much you have, how much money you need to either take it out or how much money you make and therefore you need to invest. The tricky part, obviously, for metals and mining, particularly in this environment, is early stage project, when you simply don't know what you have. You think you have something, maybe you hope or you pray that you have something. The risk, obviously, with early stage project exploration is that you do invest a lot of money, a lot of time, and you don't necessarily know whether it's going to make money at the end or all of that money is lost. Now, over the years, we've seen in this environment plenty of companies that started early stage greenfield projects to effectively see what's there and literally spending millions and years of exploration and effectively stopping at some stage. And the risk is that is regular there. That's the typical thing for exploration, not only in metals and mining, but also in oil and gas. As an independent financial advisor, we can obviously help to assess the risk, to understand what is a realistic financing structure. Is that with venture capital? Is that with private investments, with individual investors? And then going on in the next stage, potentially with private equity, before a company is ready to go to the market and the stock market or get bank financing, where in banks, typically the credit committee sits there and ticks all the boxes. That means there is no risk.
Thank you, Stefan. Thank you. Cassie.
Thank you so much. My name is Cassie, and I'm representing Alphamar. So Alphamar is I would say it's a team of international experts who decided to devote a lot of their time and energy to launch a private equity fund, and currently, which is in progress. Our primary focus is exactly what Stefan mentioned, is the really higher risk, but with understandable potential for early stage investments in Kazakhstan, Central Asia. We can look into other jurisdictions, but and we definitely need to limit ourselves in terms of our preferences. So the Golden Copper is something that we primarily focus on, and also some CRMs as well. So you can find more information on our webpage. Thank you.
Hello, my name is Alkin Konbay, and I'm representing company BAST, joint stock company, and total of private holding. We have further referred as the group. So the group has 5 assets in the portfolio, 1 producing license and 4 exploration licenses. Obviously, as you imagine, 4 exploration licenses projects are in late exploration stage. So this is what we do. We are purely mining company, and yeah, I'm happy to be here.
Thank you. Look, I prepared 7 questions. I don't know if we'll have time for all of those, and please, feel free to change you as well. If you think that there's a more important pressing question that needs to be answered, please, and you as well. And sometimes in the financial world, we use some terms. If that's foreign to you, please ask. So the first question: for those of you seeking capital, capital is timid. Capital is coward. Capital wants no risk. And then we talked about the early parts of it where the risk is highest. So greenfield, early stage, where only few holes are there, perhaps the exploration is done, but we don't have an engineering study. How is that addressed? Cassie, if we could start with you, because your fund is basically addressing that.
Sorry. Thank you, Han. Yeah, definitely there are investors and projects that at different stages everywhere in the world. So to simplify, I see that starting from jurisdiction, Kazakhstan and Central Asia becoming more and more important and understandable, visible, and maybe even trustworthy. It's not only with the job that AFC is doing right now, but it's also with the more, higher political understanding and connection that our region is really has both the resources and the willingness to work together. It helps. It helps to bring investors who really want some risk. Because, obviously for EBRD and other financial institutions, for public markets, you get to be more prepared in terms of the different requirements. But there are investors in the world, especially in Western Europe, where they really seek to have extra risk. And definitely you need to have understanding to taking this risk. And we see that the primary, I would say, the target audience for such type of investors are those who already have some background in commodity sector, in trading, in oil and gas, in mining. So anything really related to resources really helps to align the interests of investors with the projects. And this gap is really quite hard to close. But you have to cross the Rubicon. Somebody needs to do it. And probably we choose the most, I don't like the word aggressive, but quite brave strategy to help our economy to grow. Thank you.
Thank you. Alkan, with your projects, did you have difficulty accessing for capital for earlier projects? Do you think the capital is changing? CASI has a fund in the works. EBRD has a program is well established. In your mind, is it enough, or do we need more capital focused on the early phases?
Well, if we are talking about, in particular, our assets, the majority of them are in the exploration stage. And at this stage, all the funds are coming from the main shareholder, because raising debt is almost impossible at this stage. And I understand that, because investors want, as you said, capital doesn't want risk. In that case, if capital doesn't want risk, it should rest with treasury bills. But at the end, it is always about the balance between risk and returns. Fortunately for us, there are investors who are willing to take major risks to potentially get high returns. And on the other hand, it doesn't cancel out the difficulties at early stage exploration phase or a development stage of mining companies, and this is a real issue. And such platforms or markets like London capital markets is a good alternative how to raise capital for the development, for the exploration. Luckily, we have a new program by EBRD who also addresses this challenge. And for us, it's really difficult. We need to go closer to the less risk stage, whereas we will have pre-feasibility stage, pre-feasibility study, which will mitigate the major risks at our projects. So, but we hope that the market will evolve so that there will be more brave investors to come in, to participate with us, to invest with us. So
Thank you.
That's it. Yeah.
Thank you. So here's a question that I find myself discussing quite often related to critical raw materials. So they're critical. Why? Because the governments have declared them critical. And quite a bit of public financing has been mobilized. Where's the equity? So a general question for you. These are critical. The desire is to bring those critical raw materials to the market as soon as possible. The public finances, capital has been mobilized. Could we do this without the equity component, starting with the capital markets? And again, it's not gold. Let's separate copper. Let's talk about tungsten. Let's talk about germanium, titanium, tantalum, vanadium. So these critical raw materials, most of us don't know what they are, which are critical in high demand. We, in the mining industry, are tasked to deliver them to the market. Is the capital there? Starting, with you, please.
Thank you. This is a really, really important question that you're raising here. Money is certainly there, right? So the money is there in abundance. It is finding this critical meeting point between the money that investors have and the companies that are ready to raise this capital. You mentioned vanadium. We had a vanadium exploration company list on our market in 2023. I forget the name, but I can share the details. So, and we do have, I mentioned European Green Transition, they have rare earths projects. So companies do come, but as you say, nowhere at the level as we would expect them to be given the demand, the global demand. I think partly the risk averseness of investors is to blame. There's been lots of volatility in equity markets, as you know, and this volatility means that the appetite of investors for exploration, pre-revenue companies, has really declined. So they want like a massive business that is guaranteed, or copper and gold, as you mentioned. So this is one factor that impacts that. Second factor is sometimes companies are not ready to go through this whole exercise, and I'm just talking about public equity, of course, through the exchange. I'm not ready to go through this exercise, which is a little bit expensive, to attract money. So the hope is that with the support of various institutional investors, such as EBRD, IFC, and so on, companies that are going through PPP projects, etc., that we can get those businesses supported in the right way so that they can go and tap the public equity. It's by no means an easy exercise. They need to be structured collaboration. So in the UK, we do cooperate with the government to support these types of businesses.
Thank you, Ayana. Timirlan, do you want to add?
I think it really depends on where we are in terms of market cycle. So there are times when capital are more risk averse. There are times when they are less risk averse. We're currently at a juncture when the level of risk is not that high. But overall, yes, I think the right opportunity is always find right capital. And I speak about the alternative financing context. I think, we're seeing more and more deals actually financing, let's say, battery metals, like nickel, cobalt, etc. What used to be purely silver and gold evolved into more base metal financing as well. So this should also be taken into account, I guess.
Yeah.
Thank you.
Thank you. Cassie, just before Cassie, I just want to mention, is that my microphone? You can hear me, right? It's interesting because the streaming companies are becoming more and more focused on critical raw materials, which is, I think, very positive. Yes, go ahead, Cassie.
Hello? Yeah. I forgot what I wanted to say, but the thing is that it's really important when you speak not about the base metals and precious metals, but very specific ones, and the minerals that you call the CRM, critical raw materials. They're so niche and they're so specific that, expecting that it will be 100% private equity or shareholders' equity in the project, I think that will not work. You definitely need, let me call it a governmental or political support for this, because it's actually the question of not of the open market. It's more about these walls in the world which are appearing again. I don't want to call it Cold War, but it's getting colder than before, and we cannot influence this process. That's the decision made in different capitals of the world, but it's actually more a question of getting the capital and support from the countries and region that really deserve that resource. Because, if you make it purely commercial, sometimes it just doesn't make sense. Yeah, thank you.
Thank you for that. Do we have any government representatives in the audience? Yeah, we don't. So this is the discussion we often find, at least myself, is the equity component, which is very timid. That is, I call it coward, is because it doesn't want risk. That risk has to be addressed by somebody. And if these commodities have been classified as critical, I think that, in my opinion, that responsibility falls on the governments to take care of the risk so that the capital markets on the equity side could open up. Okay. Anybody else want to add to that comment?
I think the main challenge for critical minerals and especially rare earth minerals is lack of expertise on the market. Who are the investors who understand this market? And if there are a limited amount of investors, then let's look at the companies. In Kazakhstan, for example, the only company that has full-scale, full-spectrum expertise in critical minerals and rare earth minerals is Kazatomprom, and perhaps Kazzinc in some part. No junior company has that. For instance, if somebody brings to us a project relating to rare earth minerals, we don't know how to address that. We don't know how to evaluate that. And I think if the market wants critical minerals, then the government should support it. The government should facilitate this ramping up of investment in this sector, because the investors, private investors and companies, they just probably have no sufficient expertise in that. Yeah, this is the main challenge.
I fully agree with you. Any other comments, additions that you want to add to that? Okay. For anybody from the audience? Because, all right, so we had EU Central Asia Summit, 2.5 billion has been allocated. Does that 2.5 billion is the full amount for a particular project's capital? Probably not. So I think please join me, particularly you, in communicating with the government officials. We welcome their participation. We welcome their participation, particularly on the public side. But I think the industry, the industry needs help in addressing the risk component associated with the equity, if you agree with that. Please join me in communicating that. The next question, again, related to the capital markets. So for those of you who have a project, and there will be a time when you complete your DFS, somebody will give you a financial model. From that financial model, there will be what we call an enterprise value, which is the value of that project. And that value of the project will be quite different than the value that the capital markets will determine. So I'd like you to address the value of a project that has been determined based on all of the technical aspects, the pricing and all of that. Why doesn't the capital market and the valuation that has been done on paper agree? Alina?
I'll start and then I'll hand over to Stefan maybe. The valuation, the public valuation, takes into account several components. There are various models that are used, but of course the principle, the base for everything is the reserves. The reserve, the structure, and then you add various things on top. So for example, you can use, multiples, various multiples, like EBITDA multiple and so on. Investors look at your peer companies, so companies that are similar that are already listed, that are similar in what this company is doing. They could be listed anywhere in the world. So they look at their valuation multiples and then compare them to your project. Additional things that add to valuation include the strength of corporate governance, the type of people that the company has on its board of directors, who the CEOs are, the shareholder. Investors really like to look in the eyes of those people and see if they trust the story that the company is telling. Another really important aspect is sustainability. So we heard on the previous panel about Solid Core Resources, which actually received an award for their reporting, sustainability reporting. Back when they used to be Polymetal, they used to be actually in the top FTSE index on the London Stock Exchange, and they were really the darling of investors, and that was due partly to their commitment to sustainability and ESG. And that includes not only, you are essentially a mining company, right? So there isn't much you can change about your process, how you make money, but you can change the way the way you do it. So, for example, tailings management, for example, quality of your supplies, checking the supply chain, safety and risk management, all of those things also go into valuation. So I'll just pause here and hand over.
I think what you mentioned is important in terms of ESG and things like this. Let's realize capital markets follow what's happening on a daily basis, fashions. Mining projects that we're talking here about sometimes take 5 to 10 years to be evaluated properly, then may take another 5 to 10 years to actually build up the plants, the production facilities, and then they operate for 20, 30, 40 years. Now, anybody on the capital markets, particular investors, are looking for the next quarter. What is their results? They're looking for anything investors may or may not like. Any large global BlackRock or whatsoever is looking, well, are we being criticized if we invest in something that potentially, and in some circumstances clearly Metals falls on that, is considered dirty? You dig up the earth, you create lots of problems, you have environmental risks. Lots of investors at certain stages don't want to be associated with that. If in parallel there's a fashion to invest in technology because you have tremendous upside potential in making money, then people focus on that. That means in industries like mining, nobody invests. That means there is underinvestments, there is nothing happening in terms of getting new products, new plants online over a period of time. That means at a later stage, and that might be 5, 10 years later, everybody's focused on that because everybody realized, oh, we haven't done that and we need to invest. So there's fashions, there's cycles that need to be taken in consideration.
Thank you. Anybody want to add to that?
Sometimes I would just add that sometimes in terms of the valuation itself, I mean, the range between I would say the buy side and sell side, or investors and the owner of the project, is so huge just because of the different views over the potential of the project. Because, I mean, we can take into account all the technical details we have. I mean, we can hire a lot of we can hire top 4 to make like an independent valuation, etc. But in the end, the equity part of it, I mean, the value of it, I see many times that there is a huge gap between what the owner believes the project is worth and what we humbly estimate as potential investors. I don't want to say that all of them from the sell side, they're multiplying their GKZ, the Soviet resource, by today's LME price and grant you graciously 10% discount. It happens, but in this case, it's obviously no-go. I mean, it just doesn't make sense. So what I'm trying to say, sometimes you have to educate the project owners, the license holders, that I mean, it's just not that simple, and you really have to be more proactive in terms of the discounts, in terms of the understanding that we are, as investors, we are taking the majority of the risk, because as you all know, in Kazakhstan, it's really it doesn't cost you a fortune to get a license. I mean, it's really simplified. Our government made a great job in copy pasting the Australian code. So we have a wonderful code starting from 2017, but still it doesn't solve all the problems. So it's more about educating the project owners as well. Thank you.
Yeah.
Well, I've seen many cases in my practice when founders almost being delusional about the value of their project, and even if they do technically work right, meaning building a proper DCF model with all metallurgical tests behind or all the CPRs behind, they forget about one major factor. Capital markets, they want to be compensated for the risks, and the gap between market value of a company on the public market and a private company is basically these risks, because when company builds DCF, it assumes that everything already happened in the future, yeah, and no risk is included in that model. And there are a lot of risks, like mismanagement, technological risks, environmental risks, and these lists can go on and on. And founders usually don't understand that, because the market wants to be compensated for that. And that drives this huge difference.
Yeah.
Simple as that.
So let's just take an example and let's quantify this huge difference. I'll give you an example. A gold company, one asset, DFS has been completed all in accordance with international standards. Yearly production will be 250,000 ounces, mine life of 15 years. The enterprise value is 500 million. If this company goes to the capital markets for a 30% float, what do you think the valuation of the company by the capital markets would be? Oh, you know? So,
that's a great question. Look, if we assume that it's 500 million, everything else that I've been talking about is in place.
yes.
Then what's the EBITDA multiple?
Well, I did, I never
Yeah,
look
if you're
at
giving me
EBITDA.
numbers, then
I
you might-
never look at EBITDA, but
Well, I would say the company has a really good chance to be valued above 500 million.
above
Oh,
500.
definitely, 100%. If all those things that you're saying are in place, the discount here will be around where the company is from. So, as you know, for example, frontier markets companies
Let's just say
face
Central Asia.
Central Asia. Yeah, I would say it could really aim for 700 million, maybe $1 billion. With 30% free float, it'll raise I don't know, around 300 million plus. So yeah, I don't see any problem, because the numbers that you've given are really, really good.
Okay. Timurla?
Yeah. When you have multiple questions like GMAT, you always have this option not sufficient information. So I guess in this case there is not the information you provide is not sufficient to answer your question. But overall, of course, markets will assign some discount on.
There will be a discount.
There will be a huge discount, obviously, and for mining stocks in particular, this is an industry I guess very heavily exposed to capital overruns, cost overruns, right? The pre-feasibility study might assume 100 mil construction cost, but in reality it might shoot up to 300 easily. So this is an inherent uncertainty that markets will obviously embed into their pricing. This is
Look, I mean, this is what I wanted to capture, because your view is there will be a premium by the market. Your view is there will be a discount by the market.
Discount versus the shareholders, the team's internal valuation.
Yeah.
I'm afraid I would have to go with the discount. I like Ayuna's optimism, but also depends a little bit, obviously, on the market. Yeah, at a gold price of $3,000, nobody really cares, because the market will say, hey, it goes further. At a gold price of 2,000, that's a completely different game. And then we come into the details of, are we talking about, 12, 15% discount, which is probably the market average for that sort of transaction. But then again, if they perform poorly on the IPO roadshow and the management doesn't convince and it's government there, then we may be talking about completely different numbers.
Yeah. Look, thank you. I mean, it's a controversial question. There is no answer to it.
There is a good anecdote. Are we? Oh, it depends. If it's a mature, 10 years ago, I would answer to that question when I was an investment banker. But now with the EBRD, I would ask probably 10 additional questions to be able to give a range information. But if it's a mature company, EBITDA 4 to 6, depending if you are buying or selling.
Okay. One thing that I would encourage those of you that are thinking an IPO, it's going to be a pretty hard process. And then after the IPO, it will be a pretty hard process as well. You need to change your governance. But there is capital. Please, go ahead.
Yeah, I would like to add to previous discussion. I would imagine that fund managers want to make money when they buy stocks at IPO. If they know that this company will be valued at 5 times EBITDA, considering the stage and all the risks and jurisdiction, they would probably give 3 times EBITDA at the time of subscription. But this is my guess, just.
Yeah. Okay. Go ahead. There you go.
So, it's so controversial, your question. I mean, probably you did that on purpose because, you see, we have really diverse views. And our COP mentioned a very good point. Either you're on the buy side or sell side. So from my very humble perspective, from the buy side, I mean, you're talking about EV. And the company is still not producing, so there is no cash flow. So it's really, from like a practical perspective, it's more than sure that you will get some debt to finance your development and construction. So from out of this EV, you will remain with, I don't know, maybe it will be 200 million max. And I would give a huge discount for this.
Okay.
Thank you.
Thank you. Any comments from the audience? So then we have 10 minutes. I have one more question. It's related to ESG. I'll ask the question. If you think that there's another pressing question that we should be talking about, we can change it. So ESG, what does it mean to a company that is seeking capital? So what is an environmental social impact assessment? Why is it important? When should it start? Okay, we have an environmental social impact statement report. What is ESG in addition to that? Is there anything in addition to that? And how important is it to securing capital? That's the question. Is that something that we want to answer, or is there another question in the next talk?
The topic of ESG became very popular, as you remember. About 5 years ago, during the pandemic, everyone was doing webinars and seminars about this. But then actually it became, a lot of companies started doing the greenwashing, sort of making statements about gender diversity and things like that, which were sort of a bit of window dressing, not really. But I think we've really progressed in that area as a society and as corporates. So specifically for mining companies, there are actual requirements of reporting. For example, companies on the London Stock Exchange have to report in line with TCFD, Task Force for Climate-Related Financial Disclosure. So this is an actual requirement. You can sort of benchmark your reporting against that. I think the second parameter that has really progressed is around how a company publishes its ESG and sustainability-focused activities. It used to be a separate document or separate statement. Now the trend is to integrate that. So this should be part of the integrated reporting by a company, because it's not a separate thing. This is something that actually impacts all of the whole value chain of companies' business. and the executive committee and the management have to be fully across that. So I would say it's still very strong. So we talk less about ESG as a sort of acronym and more a sustainability and climate-focused reporting and risk management.
Thank you.
I think the interesting thing is that it's evolving drastically in different directions. It used to be something that only consultants talked and wrote very nice large reports about it with little content except nice words. The stock exchanges, the regulation, London Stock Exchange, European stock exchanges now have very specific requirements, what needs to be done, what needs to be reported, in the format it needs to be reported. Tricky though is it depends a little bit on who you talk to. Similar to your question, are you buying or selling? Are you talking about public markets and public transactions, or are you talking about private investors? Because the value of ESG is very differently seen. Equally, on the company side, the cost is potentially tremendous. If you work with specific institutions, if you go to commercial banks, individual institutions, you have to provide, you spend hundreds of thousands potentially on reporting that is required. If you do private transaction with a private investor, he may not really care about it because he cares more about other things. So it depends a little bit on what transaction and what context you're talking. And if we see recent developments in the US, where I've seen, for example, the first impact now in UAE and some other jurisdictions, everybody now is kind of, ESG may not be that relevant anymore. So the regulation that we wanted to put in place, maybe we wait a little bit. So there's also an up and down depending on the market.
Thank you. That raises another controversial question. We got 2 minutes since you mentioned U.S. So there's a view that with the current administration, the requirements for permitting related to environmental will be perhaps lower. If it was lower, would that change the capital allocation? Would the capital markets change their views on the importance of ESG, even in a country like US, the bar is lowered? Does anybody believe that the capital markets bar will be lowered as well?
Sorry, I mean, it doesn't work when it comes to my hand. I think it doesn't really make sense in a sense that administrations come and go, but the markets are still there. And markets do remember everything you did, especially in the huge stories of like a technological disasters, like it was in Valley in Latin America with their pile. The thing is that you cannot really dictate what is acceptable or not, because it's not only governmental vision but also societal vision. It's also the opinions of the communities, which in democratic countries, and I need to specify this, you cannot ignore. It's also from our humble perspective, I mean, it's also environmental issues. You cannot ignore them, even if you can pass. I mean, if you can make investment. The thing is that from private equity perspective, you are not simply entering the project, but you need to exit, and there is a high probability that your buyer will be probably more concerned about ESG in general, which is actually ESG is a really nice concept. So in our approach, I mean, for us, ESG is not just an empty word. We really put it in top 3 of the criteria, especially on the environmental side. Thank you.
Okay, thank you. With that, I think we're right on time. We have 1 more minute. Okay, so what I'd like to do is 1 more minute, try to use it among yourselves, last comments. Starting with Agu, if you have any. In general, not for the last question, but in general related to financing in Kazakhstan.
Financing in Kazakhstan, you know that building a mine takes, 10 years, 15 years. And unfortunately, there are, dozens of factors that impact the development of the project in the very beginning, during the construction and operations. Yeah? So we have discussed about the valuation, about the difference between the theoretical valuation and the markets. And the colleagues mentioned certain things that are important to get a higher valuation. But all those are theoretical, and but when you switch on the TV and hear the news, that can have a significant impact on the valuations. So we are living in not in an ideal world, not in a perfect world. So it's difficult to give concrete answers to some of your questions, which are very interesting and require more time and for discussions. Thank you.
So we can call it the last toast before we go. Actually, your questions were really tricky, especially I like the one with EV. It really showed the difference in everything, right, in the approaches. But in general, I'm happy that we all are here as well, because Kazakhstan and Central Asia really need to use this chance, which is given by God, to make sure that we use it for the more stable, sustainable development of our economy for the, dozens of years to come. It's great to see that there is more interest from the West, from European destinations, and I hope it will support everything we talked about today. Thank you.
It's difficult to sum everything up in one comment, but I think the interesting thing is that over the years, mining was very positive, very attractive for investments, and at some stage it was not attractive at all. People then moved into other areas. I think that given what's going on about realization in terms of where the development goes, that mining certainly has a place and will continue to have a place. There is no question that early stage mining investment is difficult and will probably remain difficult because of the risk profile. But I'm on the bottom line, I'm very positive about it, that it is possible and will continue.
Well, I probably say that's like when it comes to the issue of fundraising, like don't limit yourself just to conventional like equity or debt. Explore all possible options. You never know which one might work best.
Just to finish off, I'd say Navoy, the gold producer from Uzbekistan, Central Asian, who you're very close to, when they raised 1 billion at the rate that they raised, everyone was really exactly 5.5 times. It was amazing, and I really believe that companies like that will lead the future for mining companies in the region.
That's very good. I thank you all. Thank you very much.
Kazakhstan, the world's 9th largest country by land area, is rich in mineral resources that have long supported its economy. However, resource depletion and the need for new investments challenge the sustainability of its mining sector. With over 30 years of limited greenfield exploration, Kazakhstan is revitalizing its mining approach through policy reforms, technological advancements, and strategic investments. Recent government initiatives focus on updating subsurface regulations, offering tax incentives, and encouraging private sector participation, leading to increased private investment in exploration. The country aims to attract both domestic and international capital by tapping into its underdeveloped mineral wealth, including rare earth metals. Artificial intelligence is enhancing data processing, while remote sensing technologies like hyperspectral imaging and LiDAR improve geological mapping. The government and companies are also employing advanced exploration techniques to access previously unreachable geological formations. Despite progress, challenges remain, such as the need for sustainable resource management. Kazakhstan's strategy integrates environmental considerations with economic growth, exemplified by projects like the Aras Minerals, Saritogan graphite mine, and First Quantum Minerals sediment-hosted copper exploration. Meanwhile, companies such as Scythian Mining Group and East Star Resources highlight the role of IPOs and international partnerships in scaling exploration efforts. This session with the keynote from S&P Global will explore current trends in mineral exploration, costs and emissions, offering perspectives from industry leaders on navigating technology, policy and investment in Kazakhstan's mining future.